And it's time now for the Wall Street Beat. D.E. Shaw expected to return billions of dollars to clients after notching an 18% gain for its flagship fund in 2024. We're going to get the details with Bloomberg's Nishant Kumar, because it's not just their flagship fund. You also have their second largest fund, Oculus, posting their record performance, 36% last year. These funds, these massive multi-strategy funds, don't always need to return money to investors at the end of the day. Is this something we're going to see from more funds that have posted double-digit gains this year, in the past year?
Surely, and we have reported about Point72's plan to return their profits this year. Citadel has been doing this for many, many years. D. Shaw is obviously, last year also they returned all their profits. At least this time they're returning only half of the profits, although the gains are much higher here. So this is one of the biggest problems that investors face these days in hedge funds. They want to allocate billions of dollars to these large multi-strategy hedge funds. It's just that these hedge funds are not willing to take their money. So this industry has hit the capacity limits. There is so much money they can keep managing and still continue to perform the way they have been performing in a market neutral type of strategies.
Right.
So this is the biggest challenge for investors these days.
Well, I want to meditate on that point a little bit more, because it seems like almost sort of a champagne problem, that we're getting so big that unless we give back money, basically we won't be able to invest the way we want to in the markets that we want to, unless we basically pare down here. It sounds like that's what you're saying.
Definitely. And also there are other limits, like there are all these hedge funds at the end of the day are highly leveraged. So there is a limit on how much money they can borrow as well. Plus, the industry is running out of talent. If you want to invest 10 billions more, then you need to hire dozens of people, dozens of portfolio managers who can deploy that capital for you. So it's a combination of all the problems that multi-strats face. They are victims of their own success, essentially.
Yeah, some of them are outperforming the S&P. Not many, almost none, actually. Does that matter to these investors, that the benchmark index has better returns than these very expensive hedge funds?
Not really. So S&P 500 is not the benchmark for hedge funds, not for these multi-strat hedge funds. You go to multi-strat hedge funds to sleep well at night. You get less volatile, high sharp, alpha through these funds. If you want to replicate S&P 500 returns, you go to ETFs. So the comparison is not right. I know this is the most popular way to compare hedge fund returns, but it's not the right comparison.